Elizabeth.
And I'm Vivian.
And welcome to the Entry Level Adulting Podcast,
where we help you to navigate the confusing world of adulting,
one challenge at a time.
Welcome, friend.
Hello, and welcome to the Entry Level Adulting Podcast. I am your host, Elizabeth, with my amazing co-host, Vivian.
Hi.
And hey, what's up? So we've had quite the adulting day. I went to the DMV, had to do a bunch of paperwork for that. That was a good time, but not the adulting topic we are talking about today. Today is budgeting part 2. And that's exciting because if you listened to our last podcast, we kind of went over the 50-30-20 method and how to get started on your emergency fund. So this podcast will be sort of for the people that have now gotten their emergency fund and are looking for more ways to save and more ways to work on their 20% bucket of savings. So Vivian, do you want to go kind of quick overview different ways that we'll go over today?
Sure. So some of the different things that can go into your savings bin account in terms of ways to save are you can do retirements, so 401ks, Roth. You can also do stocks and bonds, so investing. And then, of course, you have your traditional savings account as some of the major outlets that you can use to save money additionally.
Yeah, so we're basically just going to cover those ones today, starting with, I think, the savings account. Well, let's just touch on that because we talked about that a little bit in the last one, where savings accounts are accounts you can set up at your bank. It's a specific type of account designation separate from your checking accounts, which are basically designed for a lot of cash flow, free flow. In your checking account, you're expecting to spend that money quickly. Whereas with your savings account, a lot of them have limited number of transactions in a cycle, in a pay period. And
withdrawals. They have a certain amount of
Thank
withdrawals.
you. Yes. Because the idea is you can put as much money as you want into it, but you're expecting less money to leave. And the reason they do this is not only to encourage saving, but also another unique factor about savings accounts is that a lot of times they have higher interest rates than their checking counterparts. And so an interest rate, if interest sounds like a word that is kind of scary or used to be scary, interest is basically the bank paying you money for storing your money with them. So it's sort of like a thank you for trusting us with your money. We're going to pay you however much percentage that the federal government says we can on top of that.
The downside to that, though, with a saving account is that the amount that you can get is really low, like your return. So keeping that money there, it doesn't necessarily, like if you wanted to, let's say, do a long-term investment to save for a car or a down payment on a house, the amount of interest that you get back for keeping that money there is super, super low, which is one of the hard parts about keeping your money there if you're doing it for long-term investment, for buying other things aside from just an emergency fund, because it doesn't necessarily keep up with inflation.
Right. And that's kind of what you hear a lot of politicians talking about when they're talking about the Fed and interest rates. The Fed is the governing organization that sets the interest rates for banks. And right now they're keeping the interest rates very low. This is to encourage spending to keep the economy up. Because when a lot of people are spending, then businesses are doing a lot of business, etc. When interest rates are high, people are more inclined to save, obviously, because you're getting more money for saving your money in the bank. And so that's why they're keeping interest rates low as sort of a reward for spending, which is good in the sense for the economy if you want, if you believe that the spending will help, bad if you're trying to save money with banks. Which is why it's important to look into other opportunities such as bonds and stocks that will offer better interest rates so that your money can work more for you in the time that you have it. So do you want to kind of talk about a little bit more like the time value of money and things like that are kind of more intimidating for people?
Sure. So the problem with, keeping it in the bank is typically there's like a 0.1 to 0.05% interest return. So just think about it really easily. If you put in $100 at the year ends, you would have made, let's see, if you have like a really nice bank, no one gives 0.1 really, but if they did, you would have made a whole dollar. Yay, you. So that's not like super beneficial, right? So it becomes then moving it into something else. And one of the other options that you can do are bonds and investment into stocks. And those seem scary, right? Because you hear about all these fluctuation with stocks and people losing everything they had, right? But you have to look at what you're trying to invest for. You are not a broker. You are not buying and selling stocks quick, watching the market like that. If that's your life story, good for you. But the majority of people, it's not. They can't keep up with that. It's just not realistic. And that's where people fall into a lot of problems in terms of losing lots and lots of money in the market. The beneficial part of putting it into stocks is that, let's say you put in $100 and you are looking for, maybe you're going to take this money out in 10 years, maybe even 5 years, right? The percent return can be up to 14%, right? Because even though the market has its highs and lows on different days, you are trying to save for long-term investment. This means you're looking at the overall trend, which is typically upwards, right? And that's the important part. Again, if you're going to put in for a short amount of time and pull out really quick, that's where you can get burned because timing it becomes really, really hard.
No, Vivian's absolutely right. So, what we're kind of getting at is you need to know what your savings goals are so you can decide whether or not investing or saving in like a savings account that's sort of a more quicker, easily accessible option is the right choices for you. Because investing in the market, there's more risk in shorter term investments. Like if you're putting money away with the goal of long-term goals, like the house, like the car, like a laptop or something even, or retirement is another great example, where you will essentially have time for the market to sort of even out its fluctuations and the overall trend will increase, like Vivian was saying. But if you don't have that kind of time, like you're saving for like a 6-month goal, well, maybe the market won't be that great in that short of a time, depending on when you buy and stuff. And that's typically way more than the average person, definitely me, ever cares to keep track of. And so what you can do is a lot of those brokerage sites will have trends on the funds that you buy and just all the information that you're buying before you purchase the fund. And so definitely be looking at the performance history. Look at the charges, the loads on the fund. Like, are they going to charge you for keeping it? How much expenses do they charge you to buy into this mutual fund or stock? Yeah, definitely look into that. Look into how much your transaction is. Is it even worth it to buy into this? Because they have a minimum amount to purchase as well. Like, is that within your budget? Is that within your range? There's lots of factors and there's lots of great resources. All you got to do is really Google and you'll find great, articles on, what funds are doing well. Like, I think there's some for, all those more investment sites oriented telling you about great funds and things like that. And so all you got to do is do your research and diversify your portfolio, which just means if you're buying into mutual funds, make sure you've got funds that are
wait, pause for the cause.
More well-rounded. Yeah.
Diving into words that people may not know.
This is true. Thank you, Vivian. You want to expand on diversifying?
So we're talking currently about stocks. Now, stocks you can get as a single stock for a single company, like Elizabeth and Vivian podcast company. I am so just kidding. We do not have stocks. But for example, you could get an individual stock for a company that, Nike, McDonald's, Amazon, right? All those companies have their own individual stocks and they have a price that you can buy and sell them for.
Right. And a stock is just a tiny portion of a company, by the way.
Of a company that you quote unquote own, that the company will give you proceeds for when they do good because you gave them money to run their company or do what they wanted. Now, a mutual fund, right, is like you hear the big names, the S&P 500, the Dow Jones, the Nasdaq, the Index 500. All those, right, are big conglomerate companies that come together, right? So the one I like to use the easiest is the Index 500 because it's the S&P 500 because it's the easiest to explain, right? So essentially, it's the top 500 companies, and they get together and they share you like micro bits of a stock, and they're like, hey, when you buy one of these mutual funds, these lumped together stocks, you own really, really, really small parts of like a whole stock. The nice thing about mutual funds is that typically that fluctuation isn't so much present as it is in, say, an individual stock. Right, so your net return might not be as high, but your net loss probably won't be as high either. So that's one of the benefits and differences between just a stock and then investing in a mutual fund, right? And it's again, what are you trying to do with that money and how long do you want it to be there? Also, sometimes it can be really pricey to buy an individual stock. You might not have the $300, $500 to buy one stock all at one time, right? So mutual funds are really nice because they allow you to buy really small portions, one bit at a time, without having to shell out a whole bunch of money all at once.
Yes. Thank you for breaking that down because it's good to understand those terms. So when I was talking about before about buying into a mutual fund, it's because you're essentially paying someone to manage all these tiny little pieces of stock so that your general investment is diversified. And diversifying is a strategy used in investing that's essentially making sure not all of your eggs are in one basket. That's all it means. So diversifying your investment means you're going to put a little bit of your eggs in McDonald's and then a little bit in Amazon and a little bit in, Giant or Gas or, environmental companies for more sustainable options as well, because there's sustainable investing you can do. And basically it's just so that if one company is having a bad day, but one company is having a good day, they cancel each other out. And hopefully the one having a good day is doing slightly better. So all in all, you're still making a little bit of money. And all of this is to say for savings and investings is your time is valuable. It is precious. And what you can do, it's called passive income. And interest is a form of that passive
The way
income.
my mother says it is your money making money for you.
She does say that. And when she says it, it sounds like, yeah, I want some of that, which is exactly the point. Mrs. Bracero is right. Like, you want your money to make money for you. You want to put your money to work. And so interest is the way that your money does that. So you basically have a choice. You can have your money sitting and making a cent a day, maybe in a savings account, or you can have your money sit and be invested. And granted, it's a little bit riskier, but in the long term, you could be making 13 to 30% sometimes of interest on that money. So that same amount of money, one could turn into $101 or one could turn into $300. But again, you have to think about what your goals are. Do you need the $100 right now? Because if that's the case, then you're not going to have time for that to turn into $300. So you have to think about your time first and foremost.
Yeah. I think that's a good shift into the other way that you can invest into the market, quote unquote. And that's with bonds, right? The nice thing about bonds is they're not as volatile, right? They don't go up and down like the stock market does. There's a pretty consistent trend with how they go. You do make more money typically than if you just left it in your savings account, but you may not see the net return that you would.
We'll just pause right there, though. Go ahead. No, finish your thought.
That you might, I say you might not, okay?
No, you're good. No, I want you to define a bond after you're done. Keep talking. I didn't mean to interrupt you. Finish your thought.
Yeah, so that's why bonds can be really nice. So, right, what is a bond? There's different types of bonds, right? The one bond that I really like to use that I buy is state bonds. And the reason why is those things are tax free. Now, here's the other issue with the market. That money you make, that net gain, yeah, that $300, the government clocked that and was like, yeah, we get a cut too. So that's what kind of sucks about investing in stocks. But state bonds, the government said, nah, you let us borrow your money. We're not going to tax you for this. So now you have this tax-free income, which is a perfect way to save. Because the same thing in your savings account, right? If you have a whole bunch of interest that the bank's giving you, they're going to tax you on that too. Do not forget, they're going to find your money.
Absolutely. Okay? Yeah. So basically the reason is when you're investing in the market and you're getting interest on it, that interest that you're getting is called capital gains. Don't know why. It's a fancy term. Basically means you got more money from that money you had. And so the government's still going to tax you on the more money that you got. But if you buy a municipal bond, which is basically you're buying an IOU from your state or county, where the county says, here is a bond or a piece of paper, in the olden days, now it's not a paper anymore, but it used to be, where here's a piece of paper that says in 90 days, we're going to pay you $50, but you only have to pay us $20 now. And so that's sort of their IOU $50. And they take that money and, theoretically, I certainly hope so, use it on things like infrastructure and other things that the state does.
What did you say?
We're just saying. But,
so much shame.
That's what you hope, right? I'm not a politician. I'm just telling it like it is. But essentially what it means is that since you're lending the government your money, and the government is paying you back, they're not going to tax you on it. So that's why municipal bonds are tax-free specifically, because the government says we're not going to tax you on the money that we owe you.
Right. And that's what, so those can be really nice, right, as an option for shorter term saving to say maybe buy a laptop. So typically there's like an expiration date. They're like, you let us borrow your money. Typically it's not more than 90 days. And then you get this chunk of money back from us. And there's typically a penalty if you move it out. So this isn't something that I'd recommend you do with your emergency fund, right? That's like cash you want to be a little bit more fluid. Now, in theory, you could time it so that if you had a really good amount, right, that you put it in, wait your 90 days, have a secondary cushion, and then once that 90 days expired, now you have extra cash to move into your emergency fund. That's what I did. But, right, that's just an option, right? You could play with it that way. If you have the financial ability to.
Right. So what Vivian's saying is if you've built up your emergency fund and it's just sitting in the bank, not making any money, what you can do is you can invest it into a bond and get that more money. However, don't put all of your money in the bank account into these bonds because you won't be able to touch them for 90 days without a fee. So you want to make sure you still have some liquid money in your bank account that you can use for your regular expenses. This is for money that you don't plan on touching for 3 months at least.
So what I did was I put in, we'll just use an arbitrary number, 100 because it's easy. Put in $100, right? And then I did that for a few months in a row for the last 4 months. So really I waited, 3 months. And then every month after that, I was getting this extra little bit of money coming back in my account from the extra 100 that I kept investing each month. Right? That way, as when the first one expired, then it's just a month and a month and a month and a month each time. That way, it's just like a clock that continues to just roll over. For me, that's what I did. Not with all of it, just with part of it to keep it moving.
Right. So can you break that down for me a little bit more? So you're saying basically you invested a little bit at a time, and then that way the 90 days would be up. And so you would just have a little bit more available to you. Is that what you're saying?
Each time.
That's smart.
Yeah, so.
See, I had to do it a little bit differently, but I got Vivian's mom to help me out with this. I had a lump just sitting in my bank account that I didn't know what to do with. And so I texted Vivian, and Vivian put me in touch with her mom, and they let me know that sometimes these brokerage firms will have deals running for you to open accounts. And so there was one going with me, E-Trade, but a bunch of them do a lot of them. So there's things like E-Trade, T. Rowe Price, TD Ameritrade, Fidelity.
Franklin,
There's There's so many, guys. All you got to do is Google brokerage firms and they'll probably find you themselves after that. But um, basically, sometimes they run these deals where if you open up accounts for, however much the money, I don't remember, $2,000, $3,000, $4,000, whatever it is. Sometimes it's even smaller. Sometimes it's like $100, $500. You would get rewarded with a certain amount after the 90 days as like a bonus incentive for opening the account. And I don't remember how much it was, but basically I did that. And so not only did I get a higher interest rate for the lump sum that I had, but then I also had this bonus for opening the account on top of it, which was free money and more than I was making in the bank anyway.
Plus, I got a bonus because when I referred a friend to open an account, you get an additional $50 for you and the person that goes right into your investment. So basically, right, Elizabeth got her $50 of free money. I got mine, right, of free money. Then, if she invested, I think you had to meet like a certain percentage or number in a 3-month span. And if you invested that much, each time you went up, it went up by like a percentage point.
So there's all these deals that you can look into and find to help basically like the theme for this episode, essentially, make your money work for you, as your mom likes to say. So you can get more money for the time that you have it, essentially. And make more on that passive income. So that's kind of stocks and bonds. If you have more questions, definitely send them to us. This was definitely a brief overview. I'm sure you could.
Yeah, this is a watered down.
I mean, it's a complicated topic.
Understand.
Yeah. We're just average people. We're not trying to give out invest in this specific fund and then you will, become a millionaire. That's not us. Sorry. If you're looking for that, go somewhere else.
Right. We're trying to give you the tools
exactly
to understand yourself, encourage you to go out and say, okay, I have this money. I want it to work for me. I want to retire one day, or I want to buy a house or a car, right? How do I make that happen? Because it's a lot easier to make it happen now while you're young and start before you're 2 years out before you're retired and you need a hip replacement.
Absolutely. So that's another thing too. I'm glad you brought that up. The more that we can do now in our 20s, the more the compounding interest has time. So the more, every time you get more interest, that investment grows a little bit more. And the longer you have it, the bigger it can grow. It just makes sense, right? The longer time you have, the more the time the money has to get more money. So that's kind of how the whole compounding interest, that's what they're talking about, is you're going to have interest on your money, on your initial investment. And then that investment that grew a little bit is going to get a little bit more, and then a little bit more, and then a little bit more. And just the longer it has to do that, the more you're going to end up at the end for retirement and things like that. So that's a good...
Just gain weight.
In the best way.
in your account.
What is that? Getting that Oprah dollars? What is that Fifth Harmony song?
Right? The only time anyone wants to gain anything is money.
True.
Anytime you tell your weight compounded, everyone gets upset. You say your money compounded, everyone's like, woohoo.
What about compassion and happiness, Vivian? Don't you want to compound empathy and kindness?
Yes. But, those don't compound like that. Weight and money do, though.
I think kindness can. I think kindness can compound.
Sure. Yeah.
Sorry, this isn't that kind of podcast. This isn't the mindfulness podcast, though you should listen to them. This just isn't it. Oh, that made me laugh. Okay. What were we talking about?
Oh, the third thing, right? The third type of investment is now moving towards your retirement in terms of long-term investing and reasons to save. And look, to those of you whose companies offer you retirement funds, oh boy, girl, you better invest all that you physically can ahead of time, because the government cuts their check before they give you yours. When you invest in retirement, you're essentially paying your future self first, because the money that you invest into the retirement fund, the 401k they offer you, if y'all have pensions, you lucky hoes,
So freaking true.
But if you can invest into the 401k ahead of time now, you should. And the reason why I say that is because when you invest into a 401k, it is tax reducing to do that, right? If you invest, the maximum that you can invest a year is 19.5k. It just went up a little bit. That's the most you can invest. That means for whatever tax bracket you're in, they remove that amount that you invested into your 401k out of your taxable income, which in theory could lower you a tax bracket if you're kind of on the cusp of one. It could just put you right down to the next one, so they don't take as much as your money. That's always nice.
Yes. And so that's let's just back up and define some of these terms, shall we? Since you were kind enough to remind me here before. No, you're good. You're good. Okay. Let me put my accounting hat on since I had to study reg for like an entire 2 years. Okay. So you have several different ways that you can save for retirement, which a lot of people probably aren't thinking about right now and probably think that they're too young to even start thinking about it right now.
But you should.
You should because
no one
wants to work that long. A, very good point. Actually, probably the biggest point. You don't want to work your whole life. Also, B, you the amount of money that if you save now, it will grow into later. Like there's all these sorts of like calculators you can like find online and things that just show if you can save a lot in your 20s, my mom has drilled this into my brain. If you can save, like the more you can save in your 20s, the better. And listen, most of us probably aren't in a place where we can save that full 19.6K, right? Like, and that's okay. You don't have to like, I wish. I know I wish too. Like, but you don't have to max out all of these. These are just like the limits. All right. If you can, you should. But if you can't, that's okay. Every little bit actually does count towards the thing. That's the thing. Like you will see the rewards pay off for just these little amounts. So first off, if you're not saving for retirement, definitely think about it. Second off, the different ways that you can, right? So you have pensions, like Vivian said, you lucky hoes if you have it. Because our generation, so pensions were kind of a thing, little history lesson here, for the former generation. A lot of companies would offer them as incentives to stay with the firm for 25 plus years. And then when you retire, you would get either a portion or your full salary paid to you annually for the year. Now,
it was a lot. Like you could be like half your salary, and then each year that you stayed later counted as like an additional percentage.
It's crazy.
So, right, let's say you stayed 20 years and then you ended up saying 30. Well, they give you like whatever. At the end, basically, you could leave with your entire paycheck.
And the only I
not work.
Honestly can barely fathom it right now, because the thing is, our generation will probably never see that money. If you ever do, but because we don't stay at companies that long anymore. So there's no incentive because they don't have pensions, or if they do, there's just no incentive to be there. Now, the downside is that this does not count for inflation. So like the money that's worth now probably won't be worth that. Like what you can buy with that money now probably won't even come close to what it's going to cost actually when we actually all retire in like 50 years or whatever, 40 years, maybe, if we're lucky. So that is a bummer. Also, I think the only people that I know who have them are people in unions. So like if you're a teacher, I think there some teacher unions have pensions that they will pay out for, which they should, honestly. Teachers are criminally underpaid anyway. But unless you like know that you have a pension plan going for you, you probably don't have a pension. Most people don't. And you're probably actual choice of retirement income is 401ks. So that's kind of what we're getting at when we talk about after tax and before tax 401ks and Roth Iras. It's basically incentivizing you to either pay tax now or pay tax later. Because typically when people retire, you make more money than when you start, right? That's just kind of how it goes.
When you retire, you're making less money than you did before you retire. So the theory is that when you invest that money, you are technically in a lower tax bracket, so it won't get taxed. Now, the difference between a 401k and a pension, it's seen as like a three-leg stool, right? Is how a 401k described. One is in part of it in stocks, part of it is in bonds, and then part of it is the portion that the company like pays or paid into a firm. And that's supposed to account for inflation, which isn't always the case with a pension, depending on how it's set up. So that's why they can be really beneficial. Like the stocks and bonds we talked about earlier today.
Mm-hmm.
Now you know more about it.
Now you know what we're talking about. So yes, so essentially a 401k is a fund that is set up through your company that invests, like it handles its own investments, but they do their own stocks and bonds and investments, and you contribute to that. And so if you're with a company that offers 401ks as a benefit, typically you will be able to set the percentage of your salary that you want taken out before taxes to be invested into the 401k. So you don't see that money. It's kind of like on your pay stub, which we haven't gone through the pay stub yet, but like if you are looking at it, it will be taken out with your federal FICA taxes, which are the Medicare and the Social Security, and your federal tax withholding. And so that is money that is your before tax. You will never see it end up in your bank account, but you will see it end up in your brokerage account, which is the one that handles your 401k. The benefit of this is it teaches you to live on a salary, not including that, and it's savings that's happening automatically that you don't even have to think about, which is the best.
Out of sight, out of mind. You paid yourself first. Future you will thank you when they don't have to go to work no more, unless they want to.
Unless they want to. You know, fun money's fun money. But yes, so that is definitely the benefit of the 401k. Now, that is, as Vivian said, mentioned it before tax income. So that's they take it out before it's taxed. You don't see it, right? And so when you eventually take it out when you're 65 or older, that's when you'll pay tax on it. And as Vivian corrected me correctly, essentially once you retire, then you're like not making as much money as you are currently. And so you'll take it out then, and theoretically you won't have to pay as much tax on it because you're not making any other salary. And so that's why you'll pay less. So there's a benefit to that, but you will have to pay tax on it eventually. Right. It's just not now.
But this money also in theory grows with inflation, right? So your dollar is still worth $1. It's no longer worth like 80 cents or something like it was 30 years ago before you retired. So that's the benefit. Right. Now, what's really nice about 401ks, if your company offers it, is that they're required to match up to a certain percentage. Do you understand what I'm saying? Like they have to give you a certain percentage, right? So usually it's 4 or less percent, but that's 4% extra money that's going into your own retirement, right? So the benefit of that is for your 4, they'll put in 4. So if you're able to put the maximum amount that they do for matching at the minimum, I'd highly encourage you to do that because right then you just actually added 8% instead of 4%, and you only had to put it in half. That's great.
Exactly. If you're not maxing out your employer match, is what they'll call it sometimes, then you're sort of leaving money on the table. And, you know, if you're not able to do that, that's okay. You know, don't beat yourself up about it. The fact that you're saving at all, like, counts as a win. Like, I cannot stress that enough. Like, feel proud of yourself for the $5 you're able to squirrel away. Like all of these we're talking about are goals. If you can't hit that, then just adjust your goals for your situation. I just want to keep reiterating that because I feel like a lot of times people get overwhelmed and feel like they can't save it all. And that is absolutely not the case. Everything that we're talking about is so that you can make better informed decisions for your situation. So I want to keep putting that disclaimer there. Like, do not let this intimidate you or feel like you can't be a part of it. You absolutely can. You absolutely can do this. You have to start somewhere. And it's okay if you got to start small because the whole point is that it grows.
Right. I mean, like, even if you can only do the 1%, right? That's still 2% that you got, right? It's not as nice as 8, but that's still a whole percentage that you didn't pay for. That is free money.
And it's a percent that's going to keep growing for in 60 years or whatever when you're
60
65.
years. Who do you think's gonna work for 60 years?
I don't know. I just keep throwing it out there. You never know.
No.
But yes.
No.
I know.
No.
If you save, we won't have to, right?
We are not trying to work until we're 90.
Yeah, there's facts. But yes, and so the employer match, find out what your company's policy is, put in that amount to get the maximum of their match at the very least if you can. If you want to exceed that, that's great. That's kind of where we get back into the 50-30-20. You got to decide how you want to put that 20. If you have less immediate things that you're saving for, maybe you can put more towards retirement. If you have something coming up that you want more liquid and not in retirement, then maybe you'll adjust the percentage that they withhold. So like if you're planning on buying a car or redoing a house or whatever it is, then maybe you don't want all that money tied up in retirement, and so you'll take out less of a percentage. Or, the reverse of it, if you don't have a lot of that coming up, maybe you'll put more. It's okay that it fluctuates. But that's essentially how the 401k works. Do you have anything else with the 401k you want to touch on?
Talking about redoing a house, I was like, dang, we haven't even bought a house. And then I remembered for people who have kids that they can technically start savings accounts, one for their kids, and they can start college funds for their kids. Because let's be clear. College is so expensive for us right now. And if you can get on the ball, right, in 20 years, right, your $100 could be $15K, right? Any bit could help. So one of the other things that you can do for saving, especially for parent, and I'd encourage you with young kids to start saving for their college now if you're able to, or at least starting them with a savings account, if maybe that's not for them, or they decide to do some other kind of career path. What else? Oh, for people who don't have 401ks, who are like self-employed, if you're freelance or something. So if you're self-employed, you can technically open up your own retirement account also, and it works that same kind of way. The government will not I think the limit is less. I think it's only $13K that you can invest in a year, but don't quote me on that. I know it's less than if you had like a traditional 401k, but look into that for yourself, right? Because while you might be doing and enjoying the freelance now, you do want something that maybe it's just too hard for you to be able to do that in your 60s or 70s for unforeseen circumstances. And you want to at least have that little nest egg put away just in case.
Those are great points too. Yes. And especially, I'm not as sure for the self-employed. I'm sorry. You'd have to do a little bit more research, but they do exist. And for parents, especially, I just want to also state that every little bit you can do will help build generational wealth for your kids as well. Don't feel guilty if you can't, but if that's something that you want to do, start now. They're never too young to start saving for them. The one other thing I wanted to touch on, I think we mentioned it briefly, is the other way you can start saving for retirement, which is Roth IRAs.
Yeah, I think briefly.
Yes. And there's also traditional ones, but let's not get too complicated.
That might have to be a whole separate thing.
That's a separate thing. Basically, a Roth IRA is another type of retirement account, like a 401k, that you can open with a brokerage. And the maximum for it is much lower than a 401k. I think it's $6,000 now. Mm-hmm. Yeah, $6,000. So, and you can only contribute $6,000 to it for a year. And I think there's also a limit to how much money you make. Like if you make above like $120,000 a year, you can no longer contribute. So this is specifically done. I think that's true. Again, don't quote me on that.
I don't think that one's true.
You don't think that one's true? I remember hearing that somewhere. Or maybe reading something. I don't know. I had to study a lot of laws, guys. I apologize in advance. But essentially, it's $6,000 that you can contribute to a Roth IRA, which is just a fancy name for a different type of account. But this is after-tax dollars, and so this is money that you have in your accounts that you see. It's not money that the company takes out or the government takes out. This is money that has hit your accounts. You've seen it, and you have set aside, whatever it is, $1,000 to $6,000. And you've been taxed on it. So the benefit is you've already paid tax. So when you take it out again for your retirement, you will not have to pay tax again. But this is just another way of saving that's available. And that money also will continue to grow as you age.
Right. So let's say if you don't have a 401k or don't want to set up your own like self-employed 401k, right? This is an option as a retirement to kind of help get that train moving in terms of being able to save for your retirement. Or if you're that lucky ducky person that maxed out your 401k and was trying to figure out what else to do, there you go. Another 6K.
True. I know. Another 6 to 8K you can just put away. Or even if you're a lucky duck who has a pension and just wants to add a little bit more, if the pension might maybe not cover everything they want it to cover, that's another way that you can also continue to increase your retirement savings.
So in closing, thank you so much for sticking with us. We know that this was a really long, heavy topic. We totally hit a lot of points that in theory could be their own podcast, so to speak. But again, this is just a tool to get you interested, to get you familiar with some of the terminology in a more simplistic way. So if you have any other questions, feel free to hit us up and let us know if there's other options or resources that you guys know that you feel like would be beneficial for somebody else. Please let us know.
Yes. We're all still learning. We're still learning. We're just trying to get you guys familiar with some of the options that we know are out there and that we use ourselves. And so hopefully this will help you guys start asking the right questions and doing some more research on your own, figuring out how to get that started for yourselves. But like Vivian said, hit us up for any additional questions or suggestions. If you want us to dive deeper into any of these topics and spend more time on them, let us know. But thank you.
Because we're also adulting. Yeah. We're all doing this together. There ain't no classes or nothing. Just thrown into the flames.
We're just over here trying our best, guys.
Right? Just treading water. Just tread water. Stay afloat.
All right. Take care of yourselves. Thank you for sticking around. Again, do not feel pressure. You are doing great.
You are. The piggy bank was upgraded just a little bit, but same concepts. And that's our show for today.
Thank you for joining us. We'll see you on our next podcast.
We hope you continue to face adulthood head on. We've got this.
Follow us at Entry Level Adulting on Instagram, intro and outro music by @Deku_ on Twitch.
Bye, friend.